So, despite the Federal Reserve's 50 basis point reduction from just a couple of weeks ago, yields on bonds have done nothing but climb. What exactly is going on? Hi, I'm Brandon, and that is the question we are going to discuss today. This is going to be a very kind of back to basics discussion about the Federal Reserve and the broader economy as it relates to interest rates. So, contrary to popular belief, the Federal Reserve does not directly control interest rates economy-wide. It does have direct influence by setting the federal funds rate, but outside of that, the only thing it can do is attempt to influence, is probably the best way to put it, interest rates on other investments or financial products in the broader economy. So this would be things like mortgages, bonds, stuff of that nature. Fed doesn't have any direct control over it, but it can make changes to the money supply, which would try to change certain interest rate levels on an array of financial products that are sensitive to interest rates. Now, when the Fed rate cut was anticipated and we thought about bonds and the bond market, there was consensus that this would likely result in a reduction in interest rates economy-wide, or rather yields on bonds economy-wide. But there was one other theory that persisted, and it wasn't out of line to suggest that a Fed rate reduction could indicate optimism in the broader economy. And if general investors and even institutional investors followed in that optimism, they may decide to make heavier use of financial instruments like stocks and pull money away from products like bonds. And if that took place, we of course would see interest rates rise. And that's more or less what we have seen play out exactly. The Fed decides it's going to cut rates, and it makes a pretty monstrous rate reduction announcement. And given that, it appears that Wall Street, at least as it relates to people wanting to invest in stocks, were quite pleased with that decision, and given the assurance that they needed to see signs that perhaps the soft landing is a real thing that's going to happen. So in that, we see money leave bonds, and when money leaves bonds, interest rates go up because there are fewer people bidding down the interest rate for borrowers. This is pretty basic economic stuff here. It's entirely likely that we do get a softer landing than a number of people were anticipating, at least for now, and we do see a continued boom in the overall stock market, which does probably mean yields on bonds do, from here, stay relatively high. We know that consensus right now on further Fed rate cutting is perhaps another 50 basis points in total by the end of the year, and this is kind of long out there, so the accuracy of these predictions does get a little more questionable, but maybe we end up in a situation with another 100 basis points total cuts through 2025. If that happens, we will still have a Fed funds rate that is at historical highs, at least from a 25-year perspective. In fact, if we look at Fed funds rate activity over the past 25 years, this is basically 2000 through present day, what we see is there are only 9 years in that time span where the Fed funds rate was at least 2.5%, so 2.5% or more. And if we get the Fed funds rate cutting that we are now expecting, which is basically another 150 basis points, we'll still be well in excess of 2.5% by the time that's all done. So suffice it is to say that we've grown accustomed to an environment where interest rates are substantially lower than they're at today and likely to be even a year from today. And given what's unfolded since the Fed rate cut announcement and the anticipation and growing optimism for a supposed soft landing, we may see an economy that remains resilient with interest rates that are substantially higher than they were for the past several years prior to COVID. Keep in mind that from the end of 2008 through the middle of 2017, the Fed funds rate sat below 1%, and bond rates were not necessarily in that level, but they did more or less track the overall direction of the Fed funds rate, which means they too sat at pretty substantially low levels for a prolonged period of time. This is relatively good news for people who want to buy bonds and live off the yield that they produce. It's not great news for people who want to buy a house, a car, or who continue to carry decent amounts of consumer debt and need to service that debt, because it does mean it's going to be more expensive. It also means that if you're trying to trade bonds, you're probably not wise to take a long position right now. In fact, in the past week, the Vanguard Total Bond Index, ticker BND, is down about a point and a half. If you're into leveraged bets, the Direction 20-year Treasury, 3 times leveraged ETF on Treasuries, I already said that, is down like 8.33%. So the bull position in terms of long bets on treasuries and bonds in general is not looking so good right now. But you don't really need to trade bonds. You can buy them and live off yield and be quite happy. If you are looking for things like annuities, the good news is this is all pretty positive news for the insurance industry, because it loves buying up yields, and it obviously can make better guaranteed contract provisions available to its policyholders or prospective policyholders as interest rates remain higher. And in the indexed space, it can make better provisions not only from the perspective of buying up higher yielding bonds, but a booming stock market generally does really, really well for those products as well. So the critically important thing right now, based on the data, and this could change in the next 3 to 6 months, but right now, based on the data, interest rates are likely to stay a good bit higher than we're used to them being. But that doesn't necessarily mean that we have to trade stock performance for bond performance in terms of yield. We're likely going to see the stock market continue to be resilient, as evidenced by the fact that the broader economy remains resilient. This is mostly a really good thing, especially for savers and especially for retirees and pre-retirees, because for the most part, the direction of all of the assets that are out there for your disposal are headed in the direction that you would mostly want in these circumstances. It's not a great thing for borrowers, and we'll see what impact that has on the broader economy as time unfolds. But for now, things are looking pretty positive. We're headed into a territory that we've not been in a long, long time, but that doesn't mean anything bad is afoot. It just means we have to adjust expectations and start to live in a world where we don't necessarily have to trade off the performance of stocks for the performance of the bond market.